and we are going to break down in terms that everyone can understand. We're going to pull through all of like the big words that they use just to make themselves sound important. And we're going to talk to you about what is going on from what we can see in the banking world, and in particular, the Deutsche Bank, which has been having some turmoil here the last 3-4 days, basically through the better part of last week since we are here on Saturday. So, Ryan, what are you seeing with this? I know you've been following it pretty closely. Kind of what's the vibe out there?
Yeah, I have been, because it all started when...
With a big bang?
With the big bang. But it all started when that you would hear the feds come out, right? Powell will come out, he'll say some words, and he wouldn't be as hawkish as many people thought. So what happened every time that the feds would come up and raise the rates, the stock market would increase. And I said, that's kind of strange. Why is it like, if you're raising rates, that's not good for banks, for investors and all that stuff. So
for us, the 94.9ers out there, I mean, our credit card interest rates, our mortgage interest rates are
I just had the feeling that,
crazy.
The market would just hear, hey, we're doing better with inflation, let's buy. And then, and it's been happening like that every time they come out, right? It's good for a couple days, and then they're like, wait a minute, they actually find maybe this thing isn't over. So then you have the feds coming out saying that the banks are safe and they're secure. All right, we are on our third week where some type of bank has failed, right? You had Silicon Valley Bank with them, which was more of a liquidity problem. So I guess I want to kind of say really quick that this
let's break down that liquidity problem, because we were talking about it before the show started. So just so that everyone is kind of clear on that, the liquidity problem was not that they didn't have the money, it's that they invested the money into an asset that wasn't readily accessible.
Wasn't accessible, but it was also not doing well as far as the rates. So what people do is that what banks do is when they loan a lot of money, when Silicon Valley was mostly tech startup companies, right? So it's not your typical, place that you go for a bank. And the rates went up. So did the bonds that they took out. So what happens is to make sure that they have enough equity or make sure that everything is safe to play itself, you take out bonds. But these bonds were bought at low rates, and the rates have been increasing. So a lot of times what they do is they try to work with these bonds in order to make sure everything is status quo. However, that is a little bit of a red flag, right? And what they did was that people rushed to these banks, started pulling their money out because they thought this bank was going to collapse. Now, was it going to collapse? Was it not going to collapse? It's tough to tell. It's tough to tell when it doesn't happen. But when people start getting nervous and they pull all their money out, which is the liquidity, then the bank doesn't have any money. So that money, like you were saying, Chaz, that money wasn't readily available to them. So people were taking out, trying to get all their money out. And when the well is dry and more people haven't got all their money yet, because you're talking about millions, billions of dollars.
Well, I think that's important to note is that Silicon Valley Bank in particular wasn't just like a local Essex Savings Bank, a Liberty Bank.
Right.
This was a bank for startup companies, and we're talking Meta, Amazon,
huge.
Apple. I mean, big startup companies with quite a bit of money in them. So when they get nervous and then come calling for their money, it's much different than if you or I went to our local bank and we said, I don't know, you charged me a couple fees here that I'm not happy with. Let me, pull out my money. It's
right.
Different conversation.
And just to kind of like to go over everything, like keep in mind, this is not like 07, 08. 07, 06, 08, banks invested in bad mortgages and did not know what they were getting in these tranches.
Right.
All right. This is totally different. I think what happens
this is not related directly to the housing market.
Nothing directly to the housing market. You know what it has directly? It's greed. So if I'm able to, let's say I buy a new house, all right, and I know like my wife and I would just build a house a few years ago. Well, I can't go nuts and start buying, on my credit card and buying new TVs and buying a new couch and buying this and buying this and this, because you do. You spend.
Yeah.
And I'm going to say, hey, I'm going to pay that money back. And then all of a sudden interest rates go up and I'm like, I'm having trouble paying this back. And I'm imagine I'm the bank. I gotta find ways to get this money.
Yep.
But, so that's basically what happened. It was a liquidity problem. It had nothing to do with mortgages. Now you have the Fed saying everything's safe, everything's secure. But here we go again there was another bank last week.
Well, it's funny because the CNBC article, I pulled this one up, that Janet Yellen, it's kind of been a tale of two different conversations with her. Because
she's changing her tone.
Right. So that's the strong actions we have taken ensure that Americans' deposits are safe. Certainly, we would be prepared to take additional actions if warranted, said Yellen. The statement conveyed a different message than Yellen's remarks a day earlier when she told senators that the Treasury was not considering any plans to insure all U.S. bank deposits without congregational approval. So kind of different. One day she's saying we are prepared, and the other day she's saying we have no plan of action. So in 24 hours, even her,
she's
mindset
trying
is kind of shifted.
she's trying. I mean, with the yelling at this point, she's just trying to please the people that she feels like she needs to please, right? That's why she's always singing a different tune. She just kind of wants to go with the flow. She's not going to actually have a backbone to say what's going on.
But what message does that send to our 94 Niners out there, to the rest of the people in the country who are looking for some guidance?
Or some security, which is fine. I mean, she can say a statement and say this is it, but what's happening now with Deutsche Bank, this is 3 weeks in a row now that you have a bank that's having issues. But the biggest difference, Chaz, with this bank is that people are use credit default swaps on this bank, right? So the other banks, it was just maybe a liquidity problem. They didn't have enough money. These are people, and they're smart people. You don't pull this move. I mean, the last time people pulled this move was in 08, when the mortgage crisis was happening, and they knew what was in these stocks, that what these banks had in these tranches, all these bundles of mortgages, was dog poop mortgages. No credit.
Mm-hmm.
They're not checking, multiple homes, arms that were going to completely collapse. So when you hear credit default swaps, those are people saying, I'm going to bet against it. I did I think it was a great analogy a few minutes ago when we were downstairs. Chaz is a runner, right? So if Chaz tells the whole office that he's going to run a marathon and he's going to do it at this time, and people know that Chaz is a good runner and this and that, a lot of people are not going to bet against Chaz. But if I kind of know something, if I'm looking at the numbers and I say, you know what, Chaz,
he's going to be waiting at mile 25 to trip me.
If I know Chaz hasn't been running as much as he has, or he hasn't been putting the work or whatever, I'm like, you know what, this is me going to bet against it. And that's called a credit default swap. I'm going to bet that this bank doesn't actually know what they're talking about, what they're doing. So that's a little bit more nerve-wracking.